Welcome, ADK and Financial Planning World. Dan Davis, President and Co-founder. Typically we do these type of updates at the end of a quarter, but just due to the market volatility and some conversations I've had with clients, felt doing it today, June 1st, getting out to you as soon as possible, valuable. You could really summarize what we're talking about today as financial markets and the economy. If you want a simple summary, you could say that we've started off in the bond market with the worst ever. I don't know that I've ever been able to make that kind of a comment that something is the worst ever. The second thing is that the stock market's had the fifth worst start of all time. Not the fifth worst market, but the fifth worst start. So when you sort of combine those two things together, you add in a lot of things about a war, about shootings and killings, and there's just a lot of real negative stuff that's a drag. And I'd like to be able to sort of separate, dig in, talk to you about what we saw before all of this started, what we're seeing now, and what we're expecting going forward. So if you go back into Q4 of 2021, really a couple things. Number one, corporate earnings were looking super strong. I mean, growth rates that I've only seen once or twice in my 35 years doing this. An economic situation that had moved from recovery to mid-cycle and looked strong. And then the last thing I think that was really favorable in general was market momentum. We had seen the market recovery from COVID, tons of stimulus, and just really rocking. Then you had some things that we knew were there. Inflation, the Fed was going to be tightening, and valuations were high. They weren't at bubble level, but they were definitely at premium level. All of that stuff that we saw, none of it really caused us major concern. So that when the Fed started tightening, and even before they started tightening, when they started talking hawkishly and the market responded negatively, that was not a surprise to us. That's very typical of the Fed tightening in a mid-cycle economic stage. What then exasperated it is the obvious war, and historically that adds about 2 months of negativity when you have an isolated war. I think the magnitude of Russia being the one that's involved in it, and the aggressive nature in Ukraine being the breadbasket, and some of the stuff that's happening around that has exasperated it quite a bit, because is historically the Fed tightening in that kind of bear market that we were potentially looking into would be about a 4-month thing on average, and then you add a regional war, adds about 2 months. So if all that was starting in January, it would be recovered come June. Well, that's obviously not going to happen. I mean, if you take a look at, we're sitting here at the beginning of June, to think that the markets are above where they were at the beginning of the year by the end of this month, I don't think anyone would bet that. Obviously, investing always has volatility risk that you're not aware of that until you look back, but that would be a first. The points that we're looking at right now, you can see chart number 1 that we've just pulled up, valuations and corporate earnings. Corporate earnings are growing. They're growing at a decelerated rate, which is very normal in mid-cycle. Something that we're seeing now for the first time in a while is valuations being much more reasonable. When you do PEs, for example, the fact that the market's pulled back, that corporate earnings have continued to grow, has been really favorable for valuations. I haven't been able to say reasonable valuations in a while. I wouldn't say discounted valuations, I would just say reasonable valuations. And then if you take a look at the economy, look at chart number 2. You can see in the last market cycle, economic cycle, you see the big downturn. That would end the economic cycle. We've added the new cycle onto that visually so that you can actually see it, so it doesn't get blended into all the other beginnings of economic cycles since World War II. But we're only about 2 years into that, and as you've heard me speak before, the average post-World War II economic cycle 7 years long. Doesn't mean that this one will be 7 years long, could be longer, shorter, but we've only had one time in post-World War II history that we've had that double dip recession. And you hear all the headlines on the TV news, you read the headline news that we're headed for a recession. We use different dashboards to monitor the risk of recession. My favorite one is run by a group called ClearBridge. They look at 12 different categories. And you could summarize it by saying that 4 of those 12 categories are in yellow or red. The remaining are in green. That would say to me, historically, if we're using that tool, that a recession is not likely this year or next year. You could also say that the economy is getting less good, or things are getting worse, but they're not deteriorating in such a fashion that warrants the news that we see on the headlines. So things could get worse, but I would say that's not very likely from a recession standpoint. We will have a recession. It's just not that it's in our view very close. My big concern would be if something exasperates it, pulls the recession forward. Another concern would be as if the war arena leaves Ukraine, Russia, and expands. You know, something like that could be Russia bombs Poland, or NATO does something that they weren't planning on and it's a mistake. Somehow NATO gets involved with troops, and that would be something we would respond to differently than what we have. Another would be, what if Iran and Israel flare up in a way that's not just sort of saber rattling, but really nuclear? There's a variety of others that could be exasperated, but those are the things that concern me, that we would take defensive measures if something happened and they got antagonistically worse. But I would say that you know, what we're really doing is nothing other than trying to hold our clients to being patient, and then watching to make sure that things don't get exasperated. And then if they do, then we'll need to respond that way. That's number one. Number two is we're really spending quite a bit of increased time researching electronic trading, logarithmic models, because it's my belief that those types of things are what's causing history to be a little different, and that the pullbacks are deeper than what they should be based on what's actually happening. And it's because of this, so that we'll be evaluating, are there things in the future that we should do, knowing that logarithmic and electronic trading is going to exasperate things. That's to be determined. And again, it just boils down to not doing anything that hurts us. It's my opinion that while investing involves risks, historically speaking, we've got a midterm election that's right around the corner, and that's not going to help us to get through this quickly. But I do think on the other side of the midterm election that the markets will start to recover in a way that we get through this, and 5 years from now this doesn't even register in our mind as something that we look back on. Again, things that could cause that to be different: exasperated war and economic recession coming sooner. We'll be watching those and adjust if needed. And I want to just thank you for your patience through all this. I know, especially those of you who are retired, how difficult these times can be. Know that we bake this into your financial planning. We don't know when these things will happen, but we know they will. And we're here for you. We're working diligently. We care about you. If there's something that needs to happen, we'll take care of it. If on your end there's something you want to talk about, just reach in, get a time scheduled, and we'll sit down and talk. Thank you for your time. Thank you for your trust, and signing off from St. Louis.